All right, guys. So now we have been talking for quite some time now, talking about a lot of things. And today we are going to be talking about um, a very unique aspect of smart money trading. And that is what we will refer to as the smart money institutional candle. All right. So we're going to talk about the institutional candle. Some people call it mitigation candle, right? So whatever you call it, right? Some people call it the institutional funding candle. Some people call it the FU candle, whatever you want to call it, right? So that is what we're going to talk about today, the institutional candle. All right. Some people call it mitigation candle. So if you hear mitigation candle, you're still very correct, right? So anyone you feel that you want to call it, right? So, but for me, I like to call it the institutional candle, right? So you can call it a mitigation candle. You can call it an FU candle. That is, near FU. So you can call it an institutional funding candle. So anything you feel like calling it, you call it, right? If you want to call it your nickname, bingo candle, whatever you feel like, call it. One thing about traders is that they forget that the most important thing about trading is to make money. It's not to be calling big names. That's one thing with many traders. They are focused on sounding intelligent. You know what I'm saying? The other block, they this, they that, this, that. But they're not making money from what they're saying. So the most important thing is to understand the concept and make money from it. It's not to know all these big names, all these things. It's not what's important. Just understand the concept on the chart and then make money from it. That's the most important thing in your trading, right? Just understand what the market is doing and make money from it consistently. You don't need to know big names, you don't need to know all the levels, you don't need to know those stuff, right? So let's talk about the institutional candle. So the institutional candle is a candle that is printed by an institution, like the name implies. Right? Like the name implies, it's a candle that is printed by an institution, sorry. And it's a candle that comes with intent, right? So I know that you by now you have already seen some of my videos before now. So you have to understand that there are smart money entities. There are banks, there are hedge funds, there are institutions that actually move price. That is why when the bank is on a holiday, the market does not move much, right? That's why we don't even see market movement on weekends. If you trade crypto, you won't really see much movement because the banks are not involved there. So there are banks, there are entities that are trading with millions of dollars, some billions of dollars, and they are in the financial market, right? They are trading with billions and millions of dollars. So those are the guys we refer to as the smart money entities. And there's a particular candle that they print, and that's candle we call the institutional candle. What does this candle do? This candle, the intent is to grab liquidity. So an institutional candle is a candle that grabs liquidity before the investing price. That's what an institutional candle is. So it's simply a candle that takes the liquidity before the investing price. So that means the market, for instance, now the market has an intent. What is this doing that? For instance, now the market has an intent to the market has an intent to the market has an intent to sell. Everyone is doing that. So when the market has an intent to sell, right? So instead of the market selling at once, the market will do something like this. Create the first high and then create this before dropping. All right. So this candle that was created to take liquidity is also referred to as what the institutional candle. So this candle is also referred to as the institutional candle. All right. Why that is just being so small. All right. So that was referred to as the institutional candle. That candle that was able to take liquidity. So that was referred to as the institutional candle. So this candle that grabbed liquidity, all right, that took out liquidity. So referred to as that's what we call the institutional candle. All right. All right. So referred to that as our institutional candle. So that's it. So this candle that grab liquidity before breaking downwards. It's what the first and towards an institutional candle. So institutional candles are those candles that take out liquidity, that take out stop losses before reversing price to the downside. So that's the candles we refer to as our institutional candle, right? It happens both for bullish and bearish scenarios. You usually see market grab liquidity before you want reversing higher. So that's candle that took out liquidity before going back up. What we refer as what the institutional candle. So that's candle that takes liquidity before reversing price. So to refer to as an institutional candle. So institutional candle is a candle that takes liquidity before reversing to the upside or to the downside. So now we have two kinds of institutional candles, right? The bearish one is this one that takes out buy side liquidity, takes out seller stop loss before reversing down. While the bullish institutional candle is that candle that takes out liquidity before they want to buy upwards. Now let me explain the logic behind that. Now the reason why this happens is because the smart money entities, they cannot get into whenever you're buying the market, someone else is consequently selling or simultaneously selling, right? So a trade occurs when there's a willing buyer and there's a willing seller. Now, the smart money entities are trading with large volumes, and the only way to get people to take the opposite side of their trade is to do what? Is to trade against them. So now they intend to sell. So the only way to get you to buy why they intend to sell to do what? Is to take your stop loss. So the only way they can get you, all right, to buy this market so they can sell, by doing what? By buying against you first. So once they buy against you and your stop loss get tagged, right? You have those you have got what? A buyer. So if you're selling the market and your stop loss get tagged, you have automatically what? Bought, right? So whenever you're in a trade and your stop loss gets hit, you have actually done what? The opposite of your trade. So if you are buying and your stop loss gets hit, that means you have sold at a bad price. If you're selling and your stop loss gets hit, you have bought at a bad price. So the market always your MT5 or trading platform always does that for you. It kind of does the exchange for you. So the only way to get to buy at this point, right? Because they want to sell. So the only way to get to buy at this point is to do what? Is for them to do what? To send price against everyone else. And once your stop loss gets hit, the millions of traders all over the world, once their stop loss gets hit, automatically they can now do what? They can now sell to their buy positions. So they're doing what? They're forcing you to buy their sell positions at a bad price. So you're not buying because your stop loss has gotten hit. So remember this what I've said. Whenever your stop loss gets hit, you have taken the opposite side of your original trade. So if you are buying, then you have sold. If you are selling, then you have bought. All right. So now they want to force you to buy at this bad price from them so they can sell to you. And the only way they can do that is to make price to go against you. This might sound like a conspiracy theory until you start testing it on your chart. And this is one of the most powerful concepts I use for my trading, right? So once the market takes a liquidity, this now becomes what? The area of interest, right? For you to do what? To take your trade. So now, when they bought here, this candle is what we refer to as what? Unmitigated. So you expect price to do what? To come back to that candle so they can close their original what? Orders, right? And then sell price lower. So now, your goal as a trader is to look for this kind of candles and wait for price to come back to that candle. And then you can look out for what? Your sell positions. And there are two ways to take your sell. You're either taking the sell directly from the charts, like direct sales, or you're waiting for what? A lower time frame confirmation. And preferably, I like seeing, okay, now, if you want to take the sell directly, the best way to take a sell directly is by what? By waiting for an inducement to form and then you take your sell directly. This is what I love it this way. If there's an inducement here, then I feel comfortable taking my sell directly. But if there's no inducement, right? If there's no um, inducement, I wait for confirmations inside that point. So if maybe there's no inducement now, there's no inducement forming there, the best thing you can do is to wait for a market structure break. So you have to do what? Wait for a market to give you what? A break or structure on the lower time frame inside there. So inducement might make me take if I see an inducement, I can just take my entry directly because I know that it's going likely going to drop. But if I don't see an inducement, I like to wait for what? A lower time frame confirmation. And the inducement has been talked about already. Go and watch my previous video on inducement. Right. Go and watch um my previous video on inducement. It's in this boot camp, or let's say YouTube mentorship. I've talked about inducement in great details, right? So do want to watch the video on inducement and liquidity. So the same thing applies there. When the market is comes back there, they look for what? Your trade. right? So this candle that the market took liquidity is your candle of interest. Whenever price comes back there, then you can look for your trade opportunity, right? You can look for your trading opportunity. That is, you're looking for this area for what your trade opportunity. When the market hits that POI or that institutional candle, that becomes what your area of what interest. So there are two ways you can take it. If you see an inducement, of course, I talk about that. If you see an inducement, you can go directly, just put a limit at it. Just if you see an inducement, something like this. That's an inducement now. You can also simply take your buy directly and then send buy directly. But if there's no inducement, you have to do what? Wait for what? A confirmation, right? You have to wait for a confirmation. If you don't send inducement, wait for a confirmation, right? So if market just comes back there, wait for a confirmation. Now, there are two ways to play an instrument candle. The first way is to play what? The open of the candle. That means that the open of the candle is the first of the plate. Just the open of the last. That's kind of total ability. Just play the open of the candle. That's the first way to play it. You play the open of the candle, right? So those are the three ways you play instrument candle. Either you put the limit at the open of the candle, you put the limit at the 50%, or you wait for a lower time frame confirmation. So those are the three ways you play it. Remember again, the three ways to put your limit on an instrument candle is what? As the open of the candle, right? These are the entry techniques. So you play at at the open at the 50%, or wait for a lower time confirmation. So you have to wait for this. Either you play the open, the 50%, or you wait for a lower time confirmation. And also, if you have an imbalance supporting it, you can also play the imbalance that in it. So you can play what? You can play the imbalance too. If there's an imbalance in the candle, you can also play the imbalance. So if there's an imbalance, you can also play the imbalance inside it. So you can play the created imbalance. As if there's an imbalance inside the candle, you can also play the imbalance on the traditional candle. If there's an imbalance inside it, you can play the imbalance, the created imbalance. So the imbalance created by the candle can also be played. So the imbalance created by the candle, so the close you play. Either you play with the open, the 50%, or the created imbalance inside and lower, or you what? The lower time frame confirmation. So come from lower time frame reconstruction, right? So let's go to the rate chart now to see if we can identify this concept, right? So let's look for a rate chart now. So all right, so you can see a very clear one here. Markets very clear, so I can do here. What this? So market was take a liquidity. But you can see that these candles grab liquidity and then they was broke structure up, right? So what happened? So when small candle becomes what? These last two candles, right? Because a candle one time frame can be two candles on another time frame. So for me, the most accurate way to delineate this is what? This whole move. You can just this is the whole small candle, that whole down move, right? So in this scenario now, the best thing we have done is to wait for a lower time frame confirmation. So that was what small candle there. What happened? The price come back there. See, beautiful. And then the market broke was back bullish. And the market has been buying since then. And it's very beautiful example there. Very, very beautiful example. Very beautiful example. Right. Very, very beautiful example. So you can see another one here. Watch another instruction. It was always understand turn on the market. Look at this. Look at liquidity here. What happened? This kind of what to the liquidity and what over bullish. So in this example now, the best place to have place was this imbalance that was created by what the instrument candle. Look at imbalance that was created there by the instrument candle. Can you see it? You can, I told you you can apply the open, the 50% of the candle. That's a measure from the open to the close. You're not using the week. You use the open to the close. That's how to get the 50% of the candle. So only how you do it. You can just put open to close. Then you play what 50%. So you can say 50% of at the imbalance. So for the for 50%, you know what the body of the candle, the body of the candles. So 50% would have been a very nice entry, which was at what the imbalance region, right? So either you have paid 50% or you pay the imbalance. And the imbalance actually gave us a lower time. This is a 1 hour chart. So you would have made maybe 5 minutes confirmation inside that imbalance or anything. And if you look very carefully, I think that was a 5 minutes entry. So if you check your 5 minutes time frame, that's maybe still an entry inside there. All right, so that's a very beautiful one. So let's look out for if you see bearish example. That one is called to be long. Let's see bearish examples. Let's look at GBP to see if we can see bearish examples of institutional candles. All right, let's look for bearish examples. All right, so can you see it already? What happened there? Very, very clear. Can you see this candle that took out liquidity? The market wanted to sell. So if you are looking at this, look at this doji or BP bar. Look at all these rejection candles. What happened? This candle took out liquidity before it was breaking down. So once you can take a liquidity and then breaks down, that's because of the break of structure, right? So now have what's your break of structure? So maybe around the here, this is your break of structure. So the markets came backwards to the institutional candle, right? So this is institutional candle. This is the open of the candle. If you pay the open, that will be nice. So let's open the candle. So that would have been a very nice one today. I thought you paid the open on 50%. So open was a very nice one here. Just play the open. That would have been a very nice drop for you. I would have sold all the way down. So that's just basically how to trade institutional candles. They happen on repeats, on repeats, on repeats. Right, on repeats. They happen on repeats. They happen on repeats. All over your charts, all over your charts, all over your charts, all over your charts. So that is how they play institutional candles. You can see them always have look at this one here. This candle took out was liquidity before they were breaking down. If you look very carefully, market actually sold a bit. Although it did not sell very well, market actually came to that area. Although it might hit it very well. So it kind of missed it, but the market only came, took it out before dropping. But that is still that is it. Institutional candles are not fail safe. Right? They're not constant that play all the time. You will see some losses, you will see some losses sometimes, right? And you will see losses. It's not that you must, or especially when the market begins to change trend, right? You will really see a loss. So you can look at the candle here. You can see this candle. What happened? Look at liquidity. Look at liquidity here before they were dropping. So you can see when you see candles with long wicks, play the wick of the candle because that wick can be a body. So you see candle having a kind of long wick like this, just play the low of the candle. Don't use the open. If you see candle with a long wick like this, just play the wick of the candle because that wick could be a candle on the lower time frame. So that was actually this one, nice drop. So that is just how to play sooner candles. All right. Now I want to state something before we close it for the day. So the short candles are not safe, fail proof. The reason why it's not is because whenever the market changes structure, like if the market has been giving a short candles now to the downside, like we have the short candles forming and price intends to start buying. Right? Maybe what wants to want to start buying. This is an instruction right? If the market wants to maybe it hits maybe kind of POI, maybe there's a fundamental release or something that the market actually encountered down there. So if the market hits an area of interest here, the market hits an area of interest down there. So it's very likely you see the market looking for what opportunities to do or to buy. So when the market maybe hit something inside there, the market is likely going to do what it's likely going to take you out. So expect this. Whenever the market is changing from bearish to bullish, your institutional candle is not going to hold. Remember that. That's why you should always, it's best to wait for confirmations because once the market is changing trend, your institutional candle is not going to hold. Right? So it's best to wait for what? Structural confirmations, like lower time frame confirmations before looking for this. And always use institutional candles that align with the higher time frame. If the market is bearish on the higher time frame, then look for institutional candles that align with bearishness. Not like the daily is bullish and you're looking for 1 hour is bearish institutional candles, or maybe the 4 hour is bullish and you're looking for bearish institutional candles. No, it's not wise, a wise thing to do because it can change at any time. So the best thing to do is to align, wait for top-down analysis to align, wait for the market to come to a high time frame point of interest before looking for what any entries at all. All right, so I hope this was insightful. I hope to see you guys in tomorrow's session. If you'd like to get our profit blueprint, the link is in the description. Right, it's a blueprint of what to expect from the 1st of November. I've put all together all my profit knowledge, how I pass challenges, what I know about profit challenges, everything. If I also give you guys the training we had last year, we had the training last year, which was 25,000 naira only. But in this training, I'm going to give the record of last year teachings plus this year teaching. So you have a lot of bonuses. So last year teaching will be a bonus to this year's teaching, right? So you can get it at a 50% per order price with the link in the description. But after 1st of November, the price is going to double. So if you want to get the get it before the price doubles, just use the link in the description to get your profit blueprint. Right. So I hope to see you guys in tomorrow's session. Have a wonderful day. Cheers and God bless.